Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, March 29th, 5:47 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Back to the Uptrend edition, with a disclaimer excluding financials and real estate. We'll get into that when we go through our sector analysis, which we're going to review as part of the chart analysis tonight. So check over here on the trend gauge. We upgraded leaders back to bullish, acting fine. Couple on the 21 over 21 list pierced the 21 day this week, but right back above it with the action late yesterday and today. Short term, all five of the major indexes upgraded from down to neutral. We've got the S&P now with multiple closes above the 21. The NASDAQ 100 has been above. Dow got above it today. We'll take a look at the rest of the indexes when we go through the charts. 50-day still on downtrend, but the S&P got above the 50-day today and back tested it and reclaimed it. So that's a positive, but still 3 of the 5 indexes beneath it. We want to see the S&P close the week above the 50-day moving average, as do all bulls, I'm sure. Long term still on neutral. We've got the S&P and the NASDAQ above the 200-day moving average, the Dow trying to reclaim, and mid caps weighed down by banks. Mid caps and small caps weighed down by banks continue to lag beneath the 200-day moving average. We'll check out all the charts all the important charts as we do throughout these videos. So what happened today? Well, overnight, a gap up, no particular reason for the gap up other than a lack of drama in the banking sector. No news to speak of that I could track down, but we gapped up 1% on the S&P, 1.2% on the NASDAQ, 1% on small caps, almost 1% on the Dow, and we held it. We back tested 4,000 a couple times throughout the day on the S&P. Then we got above the 50-day moving average, broke back below it, got back above it. So that was tested a couple times. So what just happened? Gap up, S&P 4,000 holds and regained to the 50-day moving average. And it was a follow-through day according to O'Neill criteria. Advantage back to the bulls after today's action. We'll see if they can maintain that advantage as we close the week out. So here are the numbers on the day. All green, RG7. This is the Revere Growth 7 ETF composite up 1.7%. S&P 500 up 1.4, NASDAQ up 1.8, Dow up 1%, mid caps up 1.2, Russell 2000 small caps up 1.1, Global 60/40 stock and bond up 0.72, in-house GROTECTION up 0.79. We'll hit the tail of the tape and review the spider sectors to explain why we're putting a disclaimer on our uptrend, the first ever disclaimer that talks about a specific sector, but really shouldn't be a surprise to anybody. See, I can make the market state whatever I want to. I could call it Pauline or Bob if I wanted to, as long as I explain to you what Pauline and Bob represented. But for now, we'll go with uptrend, excluding financials and real estate. So here's the S&P 500. You got to gap up. Let's go to the 5-minute chart here. Gap up. And then here's the back test. Look over here. We got above 4,000 2 days ago on Monday. Tried to get back above it late Monday. Not even close to it on Tuesday, but gapped above it, pulled back, held. It actually, we opened at 40.10 and we tested it early all the way back to 39.99 and then tested it again and it held. And any attempts at a pullback during the day were bought, 4,010, 4,007. So then the early high 40.17, we got to 40.19, then we broke higher, squeezing into the close, closing near the highs of the day at 40.28. Good stuff for the bulls. Let's go to the daily chart here. You can see the red line, the 50-day moving average, which is flat. The 200-day moving average is also flat. We were trying to get those to hook higher, and certainly if we pull back and test the 50-day moving average at 40.14, not too far below that, only 0.3%. We certainly want to hold that, as well as hold 4,000 on any pullback. And the next target higher for the bulls is first 40.40, where we reversed We're actually ahead of above where we were before Jerome Powell and the last Fed decision was announced. We were at 4,001 when that happened. Now at 4028, and then the last rally up off the 200-day before the banking crisis hit on 3/9. 4078 is the next target there. Let's take a look at a weekly chart of the S&P 500, and you can see pretty clearly that we've got a downtrend line here that we want to try to break through. If you put that same downtrend line on the NASDAQ 100, you can see we very clearly broke through it already 3 weeks ago. And the pullbacks at the pivot on this flat base, really, we're just putting a handle in, is what it looks like. A handle where we undercut, closed at the 8, didn't even get to the 21 over the last 6 days. Good stuff there. 313.68 is where is the next high that we want to reclaim. That's the top of the flat base. And 315.25 before the reversal after the Fed last week. But a little bit of a break we took for 3 days, a couple days, a day or two last week, 2 days this week, and Friday. All that did is give the NASDAQ 100 a chance to catch its breath. Same thing with semiconductors. We talked yesterday about how they lagged. This is a pretty severe angle on the relative strength line. 4 days of a pullback, bounced nicely off the 50-day moving average, gapped higher, closed near the top of the range, regaining the ADMA. This 438-ish area is the next area we want to get by with semiconductors, which continue to be a leading sector. That leading sector was joined today by an unlikely hero of the day, Intel, up 7.61% on 77% average volume. This thing has been the semiconductor whipping boy for a long time, clearing all of this resistance going all the way back to last September. Um, and this was helped in part by Micron. Uh, Micron and semis, it's not technically a semiconductor, it's computer in the computer data storage sector, but semiconductors react to it, and up 7.2% on 270% above average volume, despite reporting pretty weak earnings and having to guide lower, but saying we think we're on the cusp of a bottom in prices and demand coming back. So just the fact that they thought that was good enough for analysts. And when bad news meets a positive reaction, that's why the market bottoms before the recession is official, or it bottoms when the headlines are bad or when sentiment is bad. Look no further than the Micron report last night and the reaction to it today. Big stuff here. Dow Jones Industrial Average back back above the 21. 3 closes now above the 200. 21 is hooking up. Stochastic is favorable for all 5 of the major indexes now. Even the beleaguered mid cap coming well off of oversold. First close back above the 200-day moving average. Now what we can just say is it's at the top of the range, this 450, which was an area that we really struggled to get above going back to December. So we're back there at the top of the range. We want to bust through 450 on small caps and the 21-day moving average. Sorry, mid caps. Small caps still not as nice a recovery. But this false breakdown last Friday is looking like the bottom, where we attempted to sell off across the board, closed near the top of the range. At the highs for the week now, still below the 21-day moving average, coming off of overbought on the stochastic. The technicals look good, or certainly improved at the very worst case for the worst of the indexes and the worst of the sectors. We'll take a look at those when we go through the sectors. So let's go now to the dollar. Not a lot of talk about the dollar recently, but maybe it'll come back into focus with the uh, bank crisis fading for the time being. Below the declining 21 EMA, we want it there. However, it is oversold. If it comes off of there, we could stay oversold for 4 or 5 weeks. Look how we did right here back in November and December. So um, we'll see what happens. But the dollar not playing as big a role for stocks has been playing a big role for precious metals and precious metal stocks. However, let's flip to the VIX. Uh, Breaking gap down and holding, just complete contrast to the markets gapping up and holding below the 20 area, sitting near 19. This is close to where it's put in lows before. That's not a great sign. You could say that it's stretched very clearly from a perspective, and this, of course, moves inverse to the markets, but well off the 30 level, which was the uh, panic range between 25 and 30 from the banking crisis. Let's flip to the banks now. Broad bond index. Not much on the day. Bonds kind of traded in a tight range, so no bond drama. Also gave stocks a little bit of room to breathe. Here's corporate bonds, LQD, up a little bit off of the 50-day moving average. Let's look at junk bonds, JNK. They were higher along with stocks, which we want to see that confirmation, and we got it. How about yields now? Well, we'll go to the TLT first. Not much, not much of a movement there, which means we should expect yields to not have done a whole lot, and they didn't. Down a little bit on the 30-year and the 10-year TNX, up slightly. So bonds relaxing for the time being, which is also good. Now let's go to precious metals. I said the dollar was higher, ended up higher, and gold ended up slightly lower. This also looking like the fear trade, uh, acting like the fear trade is somewhat over. Look at the stochastic rolling over from overbought. We want to be cognizant of that. Sitting on the ADMA for now, kind of a tight range as bonds have been, as again, we've been drama free this week in the banking sector. So that's good. And if it continues, it's good for stocks. GDX, mild pullback after making new highs yesterday. Silver up slightly on the day. Bitcoin, risk on for Bitcoin, gap up, and it held just like stocks, up 3.61% on the day. Let's go to the tail of the tape now. You can pause it to read the whole thing. I'll hit the highlights. Uh, Technical analysis, stochastics, all the indexes positive, G6 positive. NASI RSI hooked up 2 days ago, went flat yesterday. It's going to hook up more today, not quite out of oversold, but it's going in the direction that we want it to. Technically, the dollar's in a positive position for us, and the panic seems to be over for bonds right now. Back to the bull case with the rally follow through day today and a reclaim of the 21-day moving average. Uh, Bear case will come back if we break back below the 21 EMA. News, hey, no news is good news. No banking drama. Day count, we went from a 3-day consolidation, now up 3 out of the last 4, above the 8 and the 21 for 4 days now. Expectations flipping to positive as we stay above the 21, and now got back above the 50-day moving average also. Here's the action intraday. Here are the sectors, all 11 positive. The laggards, these were up, but not up much. Healthcare and staples and retail also. On the downside, gold and silver stocks. Here's what we own in-house. We added LULU today on the gap. Uh, Kind of peaked early, so we didn't get much benefit from that. We also added to NVIDIA and UPRO, taking our exposure up to Revere volatility adjusted beta of 1.18, or 18% higher than the S&P 500. Bottom line, bulls regain control with the S&P breaking above 4,000 and the follow through day. Let's see if the bulls can maintain control. So let's go to Lulu first, since that was a buy in the portfolio. You can see the volume, 578%, up 12.72%. They beat earnings. In fact, they beat the highest estimate on the street, but the stock really didn't do anything after the initial gap up. I kept waiting for this break above 370. We made 2 buys, one at 364, one at 367, and held 360. Need to see it hold below here, the best of the gaps, We know what the behavior of the best of the gaps is because we own ON, which after a 2-day rest got back above the 30 area today. Volume continues to taper off as is expected, trending easily above the 8 EMA, also above the 5 EMA. So this is what we want them to look like. We have a template for what the uh, best gap ups are, what the stats tied to them are, where our stop levels should be because of that great gap webinar that I attended last week, and it's something we'll be incorporating into our process. And we added to NVIDIA, so let's take a look at that. It gapped up. We added around 270, and it gapped up. Didn't do a whole lot the rest of the day, but did close near the high of the day, within a point of the high of the day. So this is we've got 4% positions in First Solar, NVIDIA, and a 5% in ON, and about quarter size positions in the rest of the portfolio for whatever we own. Here's First Solar, had a gap. It didn't gap down today, but it had a pretty intense sell-off here. Somebody wanting to dump shares doesn't make any sense sometimes. Why not peter them out or spread them out during the day? But it held the bottom, and then look at the buying volume that came into this. This is normally a quieter part of the day. Very clearly, First Solar was being accumulated. We already had 4% or we'd added to it, but now we're looking, we will go as high as an 8% position in this. Then it took a break. More buying came in the afternoon. First Solar looking good. And again, this was one of those gap up on big volume, 466% volume, up 16% on the day, behaving just the way it should be, hold the 21 on a pullback, and now trying to bust out higher after 3 days of light volume. Uh, a positive reversal is good stuff for First Solar. Let's flip now to the indexes so I can explain why financials and real estate look as bad as they do. And let's start off first by refreshing your memory on IWM. So this is small caps and mid caps very clearly lagging. There's a lot of energy and financial names in here. Those both have been lagging. We're trying to put in a bottom with this very clearly, but uh, let's go through the indexes in alphabetical order, and we'll talk about why we'll grade them, good, bad, and ugly. So XLB, nothing is bad if it's regaining the 21 EMA. This sold off also along with financials. It makes sense because if banks aren't financing construction, you don't need the materials. So XLB selling off along with that, with XLF and XLRE kind of makes sense. But first day back above the 21 today, so that's a good sign. We'll give XLB a B. How about that? Next up, energy. Energy putting in the bottom also sold off, also makes sense if we're going into a recession. But 4 days up off of the low for energy back above the 21, still below the 200 and the declining 50, but we're going to give this a B also. 4 straight days up. Uh, Next up is XLF. And it's very clear why this is an avoid for now. We don't know that the drama's over. We do know that volume is starting to taper off, and it looks like we had the last washout last Friday. However, we could come out of the blue with more bad news. Um, and if we do, we do. But for now, uh, the bottom is last Friday. We haven't gotten back above the 21, but at least we've gotten back above the 8 for the first time. That acted as resistance last week when we attempted to get above it. So we're still going to give this a C or a C minus. Next up is XLI Industrials. Again, makes sense that they would sell off. If you're not financing anything, industrials are going to sell off also. But again, nice 4 days. Again, looking like they put in a bottom last Friday and they bounced at the 200-day moving average, regained the 21 today. So we're giving them a B. XLC, and we're going in alphabetical order almost. Putting in a nice cup and handle here. This is Disney, this is Google, this is Microsoft, this is Meta. Or it's not Microsoft, but it's Meta. Putting in a cup and handle, didn't pull back along with the banks. In fact, money flowed into here look at the volume, and now just some evening out as money coming out of these sectors that worked, moving into the sectors that haven't been working, that have where the bulk of the money has uh, went into over the last 4 days, since it looks like we're putting in a bottom, but nothing wrong with this. I'll give this an A, forming a cup and handle. XLK. It's an A also. In fact, it broke out. We'll give it an A plus. So there's your tight range, tight base. Didn't sell off. Money flowed into it during this whole uh, bank fiasco. Got back up to the top. Couple failed breakouts. Last hurrah of a pullback yesterday. Gapped up and held it today, and new closing highs. You get an A plus in that. XLP is next. Staples. Uh, didn't really pull back. You need during the bank crisis. In fact, money flowed into them. Relative strength, they actually improved and went sideways and then broke above it. This is still a fear defensive type trade, but this is a B plus, above the 21, above the 50, above the 200. Gapped up on Monday, held all 3 days, and worked its way higher. There are some nice staple stocks that look pretty good, but they're not cheap. Let's take a look at something like Hershey. Trades at 30 times PE, earnings 11% and 7%. That's a PEG ratio of 3. That's pretty steep. But the stock looks good. Not something we're going to traffic in. It's not a growth stock, but I do love me some chocolate. Let's say that. Okay, what's next up? XLRE. Looks awful. Was trending lower before the bank crisis. In fact, it was the worst acting before the bank crisis kicked in, and then just continued lower. Trying to come off the bottom. We'll give it a C minus. First close above the ADMA, not above the 21 yet, but reading just some horror stories about commercial real estate. With interest rates going higher, variable rate notes being reset, uh, some stuff from realtors. The exception is single family homes seem to be doing okay in the home builders, but I would avoid XLRE, and because it just that sector looks awful. On the contrary, home builders do look okay. Let's go to ITB as an exception to real estate going sideways, holding up tight, didn't sell off during the bank crisis, even though you kind of could have expected that it might have. But we had some strong earnings from several home builders come in, and they said, well, there's such a shortage of pre-existing homes that we're having to make up the gap in the supply chain for homes. People are just buying new instead of buying pre-existing or resale. So ITB still holding up all right. Next up is utilities, XLU. And this has been weak, I believe, tied to interest rates. I have a hard time making heads or tails of utilities. Sometimes they seem to be zigging when you think they should be zagging, but they are up the last 4 days after a harsh 4 day sell off. Uh, these get a C. It's above the 21, not above the 200, below the declining 50. I mean, we really don't do a whole lot with utilities at Revere. Not saying to avoid them. We kind of avoid them based on what they are. Utilities aren't growth areas, but we're not saying avoid them the way we are saying avoid sectors, the sectors for um, financials and for real estate. Next up, healthcare, XLV. Really hasn't been acting that well. Uh, didn't really accelerate its sell off. It did sell off, but not to the extent that the financial and utility or and real estate sectors did. But put in a bottom about 2 weeks ago, and price has been trending higher, but um, relative strength hasn't been. My thought for this, because this is normally a defensive sector, is that the biotech component of it. Biotech is the most risk-on sector. I did a study once trying to find what the best ETF would be to be in during a sell-off, and it would be to short biotechs. The short biotech ETF had the best returns, even better than the triple inverse Nasdaq 100. So this is the ultimate risk-off sector. Looks like it's trying to put in a bottom, but my guess is that the portion of biotechs that really had sold off, and I don't know what the exact percentage of biotech is for the medical sector. I know it's J&J is the biggest, and that looks terrible. But that looked terrible before the banking crisis hit, and now it's been going sideways. But for now, we're not saying avoid. There are certainly several great-looking medical charts out there. Vertex, for one. So, it's on a stock-by-stock basis in the medical sector. And the last sector is consumer discretionary. XLY, this is when you have free money where it goes to. Initially sold off as a move. It's not a defensive sector in any way, shape, or form. It's the complete opposite of staples. Staples acting well, you would expect this to underperform and vice versa. It's sold off uh, during the banking crisis, but again, put in a bottom 2 weeks ago. Back above the 21, below the 50 and the 200 day. Tesla's a big part of this. So is Amazon. I'll give this C plus. So that's why we're saying uptrend, but exclude financials and real estate. And really, it's been a stock pickers market. We've had no shortage of leaders. I never have a problem filling up the 21 over 21 while the indexes were lagging. But you really do need the overall market uh, wind at your back, and the wind will be at our back if we can get financials to bottom. It's said that the markets can't rally without financials participation, but I read something from Data Trek that said even as bad as the big banks were during this sell-off, it only cost 0.2% to the S&P 500 return. That's minuscule. So banks don't carry the weight that they used to. Let's just say that and be done with it. But so back to uptrend, but we're excluding financials and real estate until we get more confidence in what's going on. That's going to wrap it. Uh, as always, I didn't say what we do here at Revere, and I didn't show the magic chart. Active management, it's very clear. Anybody listening to this for the first time, keep listening, especially to Friday's video when I go through our 21 over 21 leaders list. But avoiding these is what we do at Revere. Our risk management is our number one goal. All of these take place below the 200-day moving average. When we get back above the 200-day moving average, we start putting money to work. We actually do it beforehand if we're under the 200 and get back above the 21. But we focus on moving averages and leading stocks. Uh, we didn't really have any stops hit during this most recent pull off. Any of our stops hit in the individual uh, positions that we had. But we did get stopped on our sector positions and reinstated them throughout this week, Monday and today. So active management, and I always end up the video by reminding you it's not how much you make, it's how much of that you can keep. Yesterday we talked about 2 tight days that the market was coiling for a move. We got the move today. Now the move needs to hold, and that's what we'll be watching today. Today's lows are critical. It's an inflection point, follow through day. Today's lows are critical for stocks and for the indexes and for sectors, and we'll judge everything based on its action versus today, because we also got back above the pivot from before the last Fed meeting. That's going to wrap it. And this will end up the video for a Wednesday, March 29th. This is Don Vandenbord with Revere Asset reminding you again, it's not how much you make, it's how much you keep. I thank you for listening and have a great day.